For someone who has very, very little capital and maybe makes, a few $100s extra a month, then it would probably be 90% silver, 10% gold. I mean, it all depends what your situation is. I just say as a general rule, if you have enough liquidity and you want to be able to sleep better, then have more gold. If you're worried about getting through the end game and you're worried about having enough liquidity to sustain yourself and your family as things get really crazy, I'd say get silver if you don't have any first.
Yeah.
So silver would be more important in the immediate term. And then for anything extra, go with gold just so you can have some steady purchasing power that won't change really that much.
Monetary analyst Rafi Farber of Endgame Investor offers strategic precious metals guidance based on investor circumstances. He recommends gold for those with sufficient liquidity seeking peace of mind, while advising silver for those preparing for economic disruption. This reflects silver's short-term utility versus gold's long-term wealth preservation with minimal volatility. Precious metals maintain their fundamental appeal through their ability to hold value across economic cycles. Unlike stocks and fiat currencies that can devalue significantly, gold and silver preserve purchasing power throughout history. Their stability stems from independence from any single country's economic performance, serving as universal stores of value during inflation or uncertainty when traditional investments falter. Gold's effectiveness as an inflation hedge derives from its limited supply and universal recognition, creating inherent scarcity that maintains value while currencies lose purchasing power through excessive money printing and fiscal mismanagement. This scarcity ensures gold retains its wealth preservation function regardless of monetary policy decisions. Farber warns that complete dollar collapse could trigger global bans on precious metals trade with extreme penalties, eliminating market liquidity and causing breakdown in the division of labor. Such scenarios would fundamentally alter how these metals function economically. The inverse relationship between dollar strength and precious metals creates compelling investment rationale. Dollar collapse would bring increased import costs and constrained government borrowing, forcing choices between unprecedented taxation or aggressive money printing, both accelerating devaluations. As the dollar weakens, gold and silver typically strengthen by maintaining intrinsic value independent of currency fluctuations. This makes precious metals particularly attractive during monetary uncertainty or currency debasement concerns, offering investors a time-tested hedge against purchasing power erosion that historically accompanies currency crises and economic instability. Before we begin, make sure to like, share, and subscribe. Click the subscribe button and turn on the notification bell to stay updated with our latest insights and market analysis.
Let's say if you have, let's say, $1 million, then I would want to be somewhere, and it depends on your spending taste. How much, what's your lifestyle like? For me, I don't spend that much money. I'm comfortable with saving and just meeting my not basic needs. I like a little bit of luxury, but
Right.
I'm not going to buy mansions or anything like that. So for me, it would be enough to get through the end game for my family. So probably maybe 30-40% silver and the rest gold, because I don't want the rest to move so much. For a billionaire, it would be probably mostly gold
Right.
and enough silver to get through a year. So let's say 90% gold, 10% silver. For someone who has very, very little capital and maybe makes a few $100s extra a month, then it would probably be 90% silver, 10% gold. I mean, it all depends what your situation is. I just say as a general rule, if you have enough liquidity and you want to be able to sleep better, then have more gold. If you're worried about getting through the end game and you're worried about having enough liquidity to sustain yourself and your family as things get really crazy, I'd say get silver if you don't have any first.
Yeah.
So silver would be more important in the immediate term. And then for anything extra, go with gold just so you can have some steady purchasing power that won't change really that much. The worst that could possibly happen is that there's a dollar crash and the government, all governments all over the world say you are not allowed to trade gold and silver. If you do that, we're going to cut your head off. Right?
Right.
That would mean there's no liquidity, because if you try to use liquidity, they would kill you, and the dollar doesn't work. So that would be a full breakdown of division of labor. We're talking zombie apocalypse, especially in the big cities. But I don't think that's possible, because the only way for governments to be able to successfully tell you and force you not to use gold and silver is if they are themselves are funded, because they need a lot of money to enforce those draconian evil rules, and they're not going to have it.
Right.
So it's a self-balancing act. Once the government collapses, you can trade real liquidity. It just takes time for that liquidity to get into the system. And because it's natural liquidity, it would only go to where the actual demand is instead of demand created by the inflation of the money supply, which is where money's been going until now. So you're going to have something like not a zombie apocalypse, but you're going to have a breakdown in, let's say, real estate, house flipping, trading, these real estate firms. Everywhere I go, it's like, oh, what's he doing now? I'm with my family on a hike in North Carolina. I'm like, I haven't seen some of these people for a long time. It's like, oh, what are you doing now? Oh, I'm in real estate. What are you doing now? Oh, I'm in real estate. I'm like, I don't even ask what the hell. Like, what does that mean? You're in real estate. So everybody's in real estate. So the people that are in real estate are not going to be in real estate. The only reason they're in real estate is because the prices keep going up and they keep flipping, right? And then they shave some of that off for themselves. But once the prices go down, the only way you can be in real estate is by shorting it. And I don't think anybody that I meet that's saying I'm in real estate is doing that. So they're all going to go away and they're going to have to do something else. And there it's going to be really tough. They're going to have to fit into a real economy somewhere. So no, I don't think there's going to be a zombie apocalypse. I think it's going to be worse in the big cities and better as you go out. And it's going to be the best in the country and for stackers who will collect whatever capital is left in the big cities and reorganize from there. Losing trust in currencies is a gradual process, but then it's quick. Losing trust in currencies is what we say to describe the front end of what's happening. But what's really happening on a banking side, right? A bank run, let's say like they had in the Great Depression, that would be losing trust in a local bank. And they lose your currency, and therefore you lose all your purchasing power. Losing trust in a currency is basically the same thing, except it's losing trust in a central bank. So how fast can losing trust in a central bank concretize itself, become material? Well, how fast do bank runs happen? Right? We saw with Silicon Valley bank runs happen in about an hour.
Yeah.
How long was it? It was like there was an announcement on the weekend. And then they did it on the weekend because they wanted, a 24-hour breath to take before everybody went to hell.
Right.
So how fast could trust break down in a central bank? In hours. It's not gonna take long once it starts. It's gonna be almost immediate. Then what they're gonna do in response is they're gonna print even more money. But when that doesn't work, there's nothing else to do except go back to metal or some metal derivative. And that's what we're going to see. I don't know how long it's going to happen, but it's not going to take long once it starts.
Farber expects sharp short-term declines in gold and silver as tightening liquidity forces broad asset sell-offs, with silver hit harder due to its volatility. However, he anticipates a strong rebound once the Fed resumes monetary easing, triggering a slingshot surge in both metals, a pattern consistent with their historical outperformance during aggressive monetary expansion. The precious metals market faces additional risks from potential liquidation events, particularly in gold. Market analyst Bolden warns that if global tensions persist without lifting gold prices, investors may begin selling their precious metals holdings to offset losses in equity markets. This dynamic could create downward pressure on gold prices as investors prioritize liquidity over safe haven positioning. If gold doesn't find new legs soon, we may see more aggressive liquidations as investors sell gold to balance equity losses, Bolden cautions. The gold-silver ratio presents compelling opportunity indicators for investors monitoring historical patterns. The ratio's tendency to revert to its historical meaning serves as a strong bullish signal for silver's potential outperformance. Current ratio levels suggest significant upside potential, with various historical targets pointing to substantial silver price appreciation. A shift to a 60-to-1 ratio implies silver reaching $54.82, while a move to 40-to-1 suggests $82.23, and a 30-to-1 ratio, typical during past bull market runs, points to $109.63. Let's get back to the interview.
I'm waiting for the Treasury to start raising cash net. They raised the debt ceiling back on July 2nd and July 3rd. So they have legal space to raise another $5 trillion in debt. And then there was this whole ruckus, and I was a little bit of a part of it because I didn't understand what I was looking at. The national debt went up like $450 billion in 2 days. But that was just an accounting gimmick, because what they do with extraordinary measures means lying about the debt until they count all the money they've spent while the debt ceiling was suspended. They can count that as debt once the debt ceiling is raised, but they've already spent that money. It's just an accounting catching up with the reality of the past, however long they've been doing extraordinary measures for. I don't know exactly how they work, but it's basically lying. That's what it is. So that 450 billion, it's not like they actually raised the money. So what I'm looking for is the Treasury to actually start raising the money, and you can tell that directly by how much money is in their bank account. And they don't have a bank account like you or I do. They have a bank account with the Federal Reserve. So all the money that they have is not part of the monetary system. I think this is just wind. I'm outside right now, and the wind is blowing the leaves, and it just rained. So like there's water falling on me, but it's not actually rain, so I can stay outside. Okay. So anyway, if you look at their cash balance, it's now something around 300 billion. And before the debt ceiling was raised, it was even more than that. So they're still spending money net, and that means they're spending money into the banking system. And when they spend money into the banking system from their bank account, which is outside the bank system at the Fed, that adds to bank reserves. And the reason it adds to bank reserves is because the bank system is already so stuffed with cash, it has nowhere to put it has nowhere to put the money except back into bank reserves. So when they start raising the money, they start taking out. They start sucking out of bank reserves into their bank account, and that should trigger a financial crisis because right now there's about $3.4 trillion available in bank reserves and $2.8 trillion being traded every night in the repo market with bank reserves.
Right.
So when they start raising money, that 3.4 trillion is going to go down to about 3 trillion because they're looking to raise about they want to get the balance back to about $800 billion in their bank account. And right now it's at 3. So 8 minus 3 is 5. So $500 billion. So if you take 3.4 our reserves are now, you take away 500 billion, you're at 2.9. And by then the repos should be around 2.8, 2.9. And then, you're going to get stuck somewhere. So that's what I'm waiting for. And once that happens, I don't expect silver and gold to go up immediately. I expect them to go down very strongly. Silver very strongly, gold less so. And then once the Fed realizes that they have to start creating more bank reserves, then there should be a slingshot. So that's what I'm waiting for. That's what happened in 2019, but nobody was expecting it. And I think we just had there was an article out in Bloomberg about Scott Bessent, the Treasury Secretary, asking banks how much bills can the Treasury sell without some kind of bad thing happening. So he clearly doesn't know exactly where the fault lines are, but he's aware that they're very close somewhere. And the Fed is aware that it's going to have to start QE again at some point. Before that happens, there's going to be a financial something, monetary something. Nobody knows exactly what, and then they're gonna do QE again. And then I think gold and silver should just go up from there. I look at things like where the real centers of monetary chaos are, or the potential centers of monetary chaos right now. I'm looking at Japan. The price of rice there has doubled in the past year.
Wow.
And food prices keep going higher and higher, faster and faster. So we're starting to see the cracks of hyperinflation there. And since they own so many treasuries, they're like a big fault line in the global monetary system. So I look at things like that. I look at where the first big domino falls.
Silver and gold are poised for heightened volatility as tightening liquidity pressures markets. While both may face sharp initial declines, silver more so due to its volatility, the long-term outlook remains bullish. Once monetary easing resumes, both metals are likely to rebound strongly, with silver offering greater upside potential as the gold-silver ratio corrects toward historical norms. This sets the stage for a potential revaluation of silver's role in the broader financial system. Are both gold and silver on the verge of a major breakout? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Only 4.5% have subscribed, so hit the bell icon and turn on notifications to stay updated. Your support helps us continue delivering the latest market insights to you and the entire community. Thank you for watching.